Hi, everybody. This is ACC4620, Auditing and Assurance 2, and I'm Dr. Elaine Gregory. We are going to cover the last part of Chapter 11, which is the substantive tests relating to accounts payable. A few more, but when we're thinking about those related expenses. So when we're thinking about accounts payable, management is more likely to understate that account. Why? Because understating AP makes the assets look stronger, fewer liabilities. Understating expenses creates better net profit. Remember, revenues minus expenses equals operating profit. Fewer expenses, higher net income. Management may also take some of those expenses and manipulate them by charging them to assets, such as taking routine repair and maintenance costs, which should be an expense because they don't meet the threshold of expanding the life of an asset or creating a better operating asset. But they may take those expenses and capitalize them. Now, while we like the AP to be understated because it makes the assets look stronger, when we overstate expenses, revenue minus expenses equals net profit. If we overstate those expenses, we have less net profit, which people think, well, why would you want less net profit? I mean, shareholder wealth growth, that's what you want, right? Well, if you want to minimize taxes, if you have less profit, you have less tax obligations. So sometimes understating expenses improves the net income profit, whereas overstating these expenses can reduce in tax minimization. So when you're thinking about this client, you kind of need to step back and say, what might be the motivations? If we're looking to have shareholder confidence in us and you want more people buying your stock, you may want to improve your net profit. However, if you are looking for tax minimization, you probably want to overstate those expenses. Now, when we're thinking about management's assertions and those substantive audit tests we can do, we covered some before, but I'm going to just refresh us. You want to perform cutoff tests to make sure that the AP exists at the cutoff point in the correct period. You want to review and maybe send some confirmations out to some of the vendors to see what their balances are of what the company owes them at that fiscal period and compare that to the outstanding accounts payable on the client side. You probably want to take some cash disbursements, payments, and trace or vouch them back to source documents. You probably want to review those purchase contracts for inventory for items and determine when title passes and rights of return. You want to perform those recalculations of those source documents because sometimes those source documents have different information on them. And then finally, you want to review any disclosure notes out there. Now let's take a look at the expense accounts. Again, perform those cutoff tests. Review those disbursements in the future period to make sure that they are being recorded in the proper period? Are we trying to understate expenses by pushing them out into a future period instead of pulling them into the correct period? Or are we trying to make the liabilities or make the expenses look minimal by capitalizing expenses into assets? So here are a few of the related expense accounts you might want to look at. Review travel and entertainment. Did that person travel to a supplier? Were they traveling on business regarding the company? Check the legal expense accounts. Were there any contract development that needed legal opinions on? Were we renegotiating contracts where legal had to be involved? Maybe there's some possible litigations that we could see through looking at invoices from the attorneys. Look at your repair and maintenance. Again, is it maintenance or should it be capitalized? Are we performing the correct tax calculations under the law for our tax expenses? And are we filing tax expenses correctly? If we're supposed to be filing 4 times a year, are they filing and paying their taxes 4 times a year, or at least posting the obligation of the payable? So we probably want to send some confirmations out. We want to review those purchase contracts and look at the rationale of the costs. Did purchase contract costs change? Did inventory cost change? And if so, are we going back and tracing or vouching that data back to the general ledger and back to source documents? Look for unusual, large, or adjusting entries in those expense accounts. There really should be no adjusting entries in these expense accounts. The only time you should see those is if they are moving the expense from one account to another, and those you want to check out on. Very quick review of the end of this chapter. So looking at accounts payable and those related expenses, and looking at suggested substantive tests, again, for accounts payable and for expenses. Again, please review all the contents of the chapter. And if you have any questions, please reach out to me. And I will see you in the classroom.